What if I told you that instead of chasing price after a big move, you could wait for price to come back to there where the move actually started? That's exactly what we're covering today. This is the Precision Liquidity Entry strategy, or PLE for short. It's a simple way to identify high probability reaction zones using just the 4-hour and 1-hour time frames. I've personally tested this concept across Forex, gold, crypto, NASDAQ, and etc. While no strategy is perfect, this one has become one of my favorite methods for finding precise entries with relatively small stop losses. Let's get into it. By the end of this video, you will learn how to identify high quality entry zones, how to refine them for better precision, where to place your stop loss when a stop becomes invalid, which zones to trust if you find multiple setups. Let's start with step one. So guys, open your chart and switch to 4-hour time frame. The first thing that you're looking for is a certain swing high or a swing low. For example, this is my latest trade with this strategy. The first thing you're looking for is a recent swing high or a swing low. Notice I said recent. If the swing happened a long time ago, I usually ignore it because older zones tend to lose reliability over time. Once you found the clean and recent swing, such as this one, you move to the next step. So step two, find the origin candle. Now we have to, since like we have opened the 4-hour chart and find it out just right here, right? So, and then we find the origin candle in the 4-hour chart. Now identify the last candle of the opposite color or the opposite move before the impulsive move that created that swing. For a bearish move, look for the final bullish candle. For a bullish move, look for a final bearish candle. This candle represents what I call the origin zone. Draw a rectangle around the entire candle, including both wicks. Don't ignore the wicks. This rectangle becomes your 4-hour reference zone. So let's do our next step. So since we found our swing low, then we have like went here. This is the last candle before swing low. We do this. Boom. Okay. Find the origin candle. So our step three, we have to refine the zone. Now switch down to 1-hour time frame with me. Switch down to 1-hour time frame. So when you switch down to 1-hour time frame, inside that larger 4-hour zone, you'll often find a more precise opposite colored candle that started the move. So for this, we can say this candle is fit, but normally you can find and create better opportunities and execute better. So draw a new rectangle around that candle. So instead of the whole 4-hour chart, we just draw it around the actual last candle in the 1-hour time frame. This refined zone is the one you'll actually trade from. Using the 1-hour refinement usually gives tighter entries and allows for smaller stop loss. So step 4, we wait. This is where most traders fail. They see the move and immediately jump into the market. Don't. Your job is simply to wait for price to retrace back into your refined zone. The market comes to you, you don't chase the market. So, where should you enter? This is something many people misunderstood. Your zone isn't a single price. It's an area, as you can see. It's an area. Price might reverse after entering only 10% of the zone, as you can see in this example, like it nearly go 50%, but sometimes it just goes like this. It just goes this, and then boom, it goes down. So sometimes it reaches 10%, sometimes it reaches 25%, and sometimes it reaches 100% even. So sometimes it fills the entire zone before reacting. Nobody can predict exactly how deep the retracement will be. Personally, I prefer entering from the 50% zone of the zone. It's a great bet. 50%, as you can see, it nearly came here 50%, so I entered right from here. So I would prefer entering around 50% level because it offers a good balance between confirmation and risk to reward. However, keep in mind that some excellent trades reverse much earlier, meaning traders wait for a deeper retracement may miss the move completely. There isn't a perfect answer for this. Choose an entry model that matches your own risk management and remain consistent. So, let's get into your stop loss. For take profits, I usually target liquidity. Previous highs, previous lows. For example, when I took this trade, I tagged here. And then it was a short trade, so I entered from 50%. This is like probably 25% or so. So you put your stop loss right here. So if you have to talk about your stop loss, the stop loss is straightforward. Place it just beyond the opposite side of your refined zone. I will say right here is good. If price clearly breaks through the zone, then the setup is no longer valid. Take the loss and move on. No strategy wins every trade. So, for take profit, I usually target liquidity. Uh, Previous highs, previous lows, equal highs, equal lows. Other obvious liquidity pools. Liquidity itself is a large topic, so I'll make a dedicated video explaining exactly how I choose take profit targets. So in this trade, I tagged my liquidity zone right here. It was around here, probably right here. It was right here. So as you can see, the risk to reward ratio is huge, 7.24. Stop loss right above the zone, and take profit in the liquidity grab. Right here is a great liquidity grab. The recent swing low. It's this place, but I will prefer here. So, let me give you guys some examples. So, here we can see the trade. So, this is the last candle for the move. When we hop onto the 1 hour chart, you can clearly see that the actual zone is right here. This is the last one, right? And then we wait. The price retraces back into the area. We enter from anywhere we want, but as I said, 50%, right here. Then boom, stop loss right here. And then the liquidity grab. So here, it's a great liquidity grab. Or even here, I would say here is good. This place, yeah, this is great. So yeah, as you can see, guys, this was an example. So, when is the setup invalid? This is just as important as finding a setup. I avoid taking the trade if this zone has already been broken before the retests. Even a small violation tells me that the area has already been tested and is no longer reliable. The swing is too old. The swing being too old is another red flag. Price structures generally produce better reactions. The market is experiencing exceptional volatility because of major news or unexpected events. That's a thing that you should focus on when you're using the strategy. Never enter a market that is unpredictable at the moment. Always, um, always like you should know the news, and it shouldn't experience volatility because of major news or unexpected events, as I said. During those conditions, price can easily push straight forward through technical zones without respecting them. Sometimes the best trade is no trade, guys. What if there are multiple zones? So, do I have an example for it? Yeah, I do, I guess. So it's not a big example, but I can say, uh, this could be, let me see. Okay, we're lucky we found an example. But it couldn't be because, as you guys can see, price broke above it. Even though it retraces back into it, it doesn't matter because it just broke above it. So this is not valid, but let's say, yeah, I can say, but it's also got broken. So, I currently couldn't find such thing, but guys, if there is multiple zones, let's say we have a zone here, and then it went up. Let's just imagine, right? It went up, and then it traced back again. So retracements, boom. So we have two zones, for example. Which one should we rely on? So we have two zones. Okay, so let's say this was like this. It went up and then it went down. So we have zone right here, and then we have the zone right here. So which one should we listen to? This is just imaginary. Which one should you trust? Generally speaking, I give more attention to the outermost untouched zone. So the upper or the lower one, like the farthest one. That usually represents the strongest area where the move originated. However, that doesn't mean the inner zones can't work. Both can produce valid reactions. The outer zone is simply the one I prioritize first. So, final thoughts is that remember, this strategy isn't designed to predict the future, it's designed to identify areas where price has previously shown strong buying or selling interest and where another reaction may occur. So, guys, let me just show you guys some examples of this strategy. So, up onto the 4 hour. 4 hour, yeah, for example, this we say, so this was the first, like you should do this because it's the last candle before our swing. Hop onto the 1 hour chart. Yeah, hop onto the 1 hour chart, and then boom, the actual one is this one right here because it's the last one. And then boom, as you guys can see, enter the trade, bonks from here, 50%, or whenever you want it, actually. Then liquidity zones here or here, I would say here. This is a great liquidity zone. So boom, and then boom, as you can see, guys. So, another one right here. Let's see. So I don't really, when I said the zone needs to be untouched or unbroken before, but for example, this lid is broken above our zone. So I would say, yes, it could be a red flag, but this is also could be a fast liquidity grab and then it went down. But if this happens, for example, boom, breaks above, closes above. Like closing above is the most important. So if it closes above, yeah, that's invalid. But if the lid goes above, just like a liquidity grab, I think you can just uh, don't take it too seriously. Let's say this happened. Price went down, and then boom, it closed above, and then went up. Then the zone doesn't count, okay? Then it is invalid. But this is just a liquidity grab, and it doesn't close, so it's still valid. Um, so for example, I have another thing right here. So this was a fail, as you can see. It didn't react it didn't retrace back to the area and then went down. It broke above. So, guys, no strategy has a 100% win rate. The goal isn't to win every trade. The goal is to consistently take high quality setups, manage your risks, and let probability work in your favor over many trades. If you want to improve with this strategy, don't immediately trade it on live account. Go back through historical charts, mark your zones, practice your entries, review your results. Example, do we have anything? Yeah, this one right here is an example. Boom. So this is the trade. This is the candle in the 4 hour. We hop onto the 1 hour chart real quick. Yeah, we hop onto the 1 hour charts. Boom. And we actually tag this one because it's the last candle, the actual final candle before the swing. And then boom, it touched the zone. We said 50%, and then we entered from here, boom. And then liquidity grab right here. Then this right about the zone, right below the zone. And then as you guys can see, 7 risk to reward ratio. Or if you want to be guaranteed, boom, 5. You know, stop loss is too low, very low in this type of strategy, in my strategy. Yeah, guys, so the more charts you study, the better you'll become at recognizing quality setups. Oh, I was actually in the 30-minute time frame. If you guys are asking why can't I do this in 5 minutes or 15 minutes, so guys, like it can always work, but 5 minutes liquidity grabs, 5 minutes supplies demands, they don't really seem to be strong, and they are not getting respected. They are always getting broken, so I wouldn't recommend it. Yeah, it could work sometimes, but as I said, 4 hour time frame, we spot it. 1 hour time frame, we actually make it better, more consistent and accurate. And then we execute 50%. So guys, if you find this video helpful, consider subscribing because I'll be posting more videos on liquidity, market structure, risk management, and other trading concepts. Thanks for watching, and I'll see you on the next one. This was a Precision Liquidity Entry strategy. Thank you guys. See you in my next video.